Your mortgage isn't set by your bank, your retirement isn't protected by your broker, and your financial future isn't controlled by the Fed. It's controlled by a $145 trillion market you've probably never looked at. And once you understand how it works, you'll never see money the same way again.
For decades, the standard advice given to anyone approaching retirement was simple. As you age, move out of stocks and into bonds. Stocks grow your money, bonds protect it. In a classic 60-40 portfolio, the bond half was sold as the conservative default. It was supposed to be the seatbelt. Then came 2022. To fight inflation, the Federal Reserve raised interest rates faster than at any point in 40 years. They pushed the federal funds rate from near zero to over 4% in just 9 months. The broad U.S. bond market dropped 13% that year. Because the S&P 500 was falling at the same time, the supposed safe conservative 60-40 portfolio lost about 16%. The seatbelt did not catch anyone. It was attached to the same crash. This chart tracks U.S. long-duration bond returns historically, and the massive drop on the right shows the longest duration safe assets on Earth losing 39.2%. A Santa Clara University analysis confirmed 2022 was the worst single year for these bonds going back to 1754. Despite that massive financial destruction, the United States government did not default on any of its debt. Every scheduled interest payment was made in full. So how did millions of retirees lose a historic percentage of their life savings in an asset that paid exactly what it promised? Because most people who think they own bonds don't actually own bonds. They own a completely different, unshielded financial instrument called a bond fund. To make sense of what broke your portfolio, you have to understand the single mathematical reality that dictates the entire $145 trillion bond market. When interest rates rise, the price of existing bonds falls. They move in opposite directions every time, without exception. Buy a $1,000 bond at 3%, paying $30 yearly. Later, new bonds pay 5%, giving $50 for the same $1,000. To sell your old bond, drop the price until $30 yields 5%. Your $1,000 investment shrinks to $600. You haven't lost any future payments. The bond still pays $30 a year, and it returns your original $1,000 at maturity. The drop in price is simply the strict mathematical necessity required to make an older, lower-paying asset tradable on the open market. If you buy an individual bond and hold it, you bypass that rule entirely. You can completely ignore the price drops along the way because the contract guarantees your principal back on a specific maturity date. A bond fund never matures. Structurally, it is a constantly rotating basket of thousands of bonds being bought and sold by a manager. Because there is no finish line where the fund hands you your principal back, the entire basket is marked to market every single day. When interest rates rise, the mathematical drops in price hit the fund instantly, turning temporary paper volatility into permanent losses on your statement. There is a specific metric that measures exactly how vulnerable a fund is to this trap. It is printed directly on every bond fund's fact sheet, usually right where investors stop reading. It's called duration. Duration is not a measure of time. It is a hidden loss multiplier. It gives you a rough estimate of exactly how much wealth a fund will bleed out for every 1 percentage point rise in interest rates. The 2022 crash wasn't a mystery. When the Federal Reserve spiked interest rates, they triggered the duration multipliers sitting silently inside millions of safe retirement portfolios. This split-screen visual measures exactly how duration scales the damage. On the left, consider a retiree with $500,000 in a standard index fund. If her fund has a duration of 6, a 1-point rise in rates cost her exactly $30,000. On the right, we see the effect of placing that exact same $500,000 into a long-dated treasury fund with a duration of 17. That identical 1-point rate hike destroys $85,000. It is the exact same initial investment and the exact same rate move, but the hidden multiplier dictates the severity of the financial injury. If any portion of your money is sitting in bond funds, you have to know your exact exposure. Log into your account, pull up the fund's fact sheet, and locate the duration number. Anything above a 7 means your fund will move meaningfully when interest rates shift. If the duration is above 15, you are no longer holding a conservative asset. It is going to swing with the violent volatility of a speculative stock. Blindly trusting the word safe on a prospectus is the single greatest risk in a retirement portfolio. True financial protection doesn't come from a label, it comes from knowing the math that quietly prices your life.